Welcome to this week's edition of Reverse Mortgage Weekly, where we go over the reverse mortgage problems that come up with this product, and also look to really enlighten all the issues or things that come up with this program, and explain it in very clear and simple terms. Here, I'm your host, Zach Smith, owner of Chariot Financial. Let's get right into it here. So hopefully everybody's doing well today. Once again, my name is Zach Smith. I own Chariot Financial. I've been in the mortgage and lending industry since 2003. I've been voted as a 5-star professional since 2018. I did the stats on that earlier in the year, and I think there's only like 17% of mortgage professionals here in Colorado that have had that distinction since 2018 for the last 6 years. So I am a certified senior advisor. That is a national accredited organization that helps make the lives of older adults better. Also, I'm a wholesale mortgage broker. So, I've worked for a lot of the major banks, Chase Bank, and was a loan officer with Pulte Homes for a long time. Did a lot of the Del Webb communities down in Arizona, financed a lot of those. But in 2019, I said, to heck with this, and started my own business, Chariot Financial, and it's the best decision I ever made. So let's get into the presentation here. So who qualifies for a reverse mortgage? Let's make this a little bigger for you. There we go. That's what we want. So who qualifies for a reverse mortgage? Well, you have to be 62 or better, 55 in some cases. There are proprietary products that are offered where you can be 55 or older to qualify for those type of programs. Now, a lot of times we use those programs if you're in a condo complex that is not considered FHA qualified. Every condo complex has to be FHA certified. Sometimes we can do spot approvals, but that's not always the case. We can look at different programs for that. Good thing about those programs is there's no upfront mortgage insurance premium. Again, that's one of the things that people don't like about this program, because it's a hefty fee up front. You don't have to come out of pocket for it, but it is a fee nonetheless. So when you sell the property, you have to pay that fee, essentially. But there's no upfront fee, but the rates are much higher on those programs, and they don't offer as much benefit. And in some cases, they may not offer them at all. It's all kind of a case-by-case basis. The raise in interest rates has really affected the reverse mortgage products quite a bit. So that's something to kind of keep in mind. It has to be your primary residence. So what does that mean? It means it's the property that you file your taxes under, and you got to be there at least 6 months in a day. Now, do we have folks who are snowbirds who have a reverse mortgage? Sure. Yeah. You live here half the year and live in Honduras the other half a year or wherever. Yeah, it's not a problem, as long as it's your primary residence. You also do need equity or a large down payment for these programs, especially with the rates where they're at right now. So that is something to kind of consider. That's the number one reason people don't qualify for these programs, is because they don't have enough equity. Keep in mind, mortgage financing and everything we do as mortgage people is really geared around risk, determining risk. If you're going to borrow $400,000, the bank wants to know are we going to get it back? What kind of a borrower are you? What kind of risk are we taking by lending this money out? Well, on a forward mortgage, the biggest risk is your income, your assets, and your credit, because you have to make a monthly payment every single month. So they have to determine, do you make enough money for those payments? If there's a rainy day and your car goes out or something, do you have enough assets to cover your enough reserves in your assets to cover those type of expenses? And number three, what kind of history do you have of paying people? What's your credit look like? Well, on a reverse mortgage, the payment is optional. Yeah, that's right. So if you want to make a monthly payment on a reverse mortgage, you can, but it's optional. It's not something that you have to do. So what that means is that the risk assessment is completely different. It's much easier to qualify for a reverse mortgage income wise. And that's one of the things that a lot of people feel like is a barrier to them to either downsize out of their current residence or to get a mortgage in general, is that they feel like, well, I don't make that much money. I'm on Social Security. I'm on a fixed income. How am I going to qualify for a mortgage when I have a fixed income like that, not bringing much in? Well, because there's no monthly payment, really the biggest factor or risk factor to the bank is time. So what do I mean by that? Well, someone who is 62 can borrow less than someone who is 82. These programs are based on actuary tables, much like life insurance, in a sense that they're banking that the person who is 82 will live in the property less time than the person who is 62. So they're going to grant the person who's 82 more equity that they can borrow from, if that makes sense. But that's how these properties are determined and how the mortgage amount is determined. Also, again, minimum income qualifications, not like a forward mortgage, but they have to make sure that you got enough money to cover your maintenance on the property, your taxes, HOA if you have one, things like that. They want to make sure that you have enough funds to qualify for that. So continued reverse mortgage information. Most of these programs are FHA loans. If it's an FHA, they call it a home equity conversion mortgage, which is HECM program. According to the U.S. Department of Housing and Urban Development, more than and this number has gone up significantly, but at the time of this slide, it was 500,000 households across the nation are using a reverse mortgage. The amount of money available from a reverse mortgage is determined by the age of the youngest homeowner. So again, it's your age. Number two, the current interest rate. Interest rates have gone up, so they're basically offering less access to equity with those programs. The value of the home also comes into play as well, because that's essentially used as the collateral. There's a misconception with this program that, there's a few myths that go into what I hear on a daily basis from folks. And one of them is that the bank wants you to go upside down and they want to take the title to your home if you do a reverse mortgage. That couldn't be further from the truth. Now, if you go upside down on the mortgage, the bank just lost and you won. Because if they go upside down, or if you go upside down and they have an asset that is worth less than what you owe on it, well, you just took the bank for a ride. Now, if the other way around is usually how it works. Generally, you'd have to become like 120 years old to go upside down on these programs. Now, that's in a healthy market. Market's in kind of a weird place right now, at least here in Colorado it is. So healthy market, we're talking 4% appreciation year over year on your real estate. Not like the 20% that we had, in 2020, or not like something negative like we would have in 2008. We're talking a healthy market. The index rate is based off the adjustable rate. Most of these are adjustable rates too, so just keep that in mind. So it's good and bad. The good thing is that if the rate goes down and you're in adjustable rate, well, gosh, you don't got to refinance. You basically the rate just goes down automatically. Bad thing is the rate goes up, it's going to go up automatically. But again, that's a big deal. If you're in a forward mortgage and you're paying a monthly payment out of pocket, if you have an adjustable rate mortgage, let's say it adjusts every month on your mortgage, and what if the rate goes up, and that means you got to come out of pocket more money that very same month to basically compensate for that rate increase. Well, what if you didn't have a monthly payment? What if you didn't have to make a monthly payment out of pocket? Does it matter if the payment goes up? Not really, because you're not really coming out of pocket. Now, is the amortization going to be higher? Yeah, you're going to have a little bit higher amortization on the loan, but you're not going to have to come out of pocket. And that is the very key to this program. That is the key, is that the fact that you don't have to make a required monthly payment out of pocket. this is the thing, most people will get a 30-year fix thinking it's the best thing since sliced bread, but that program is completely, that those terms are stacked against the consumer. All these first-time home buyers out here, and I'll bet you there's somebody watching this right now that was a first-time home buyer at one point, and they got a 30-year fix thinking this is the greatest thing ever. And yeah, it's great to buy property. Don't get me wrong. Buy, buy, buy. Go west and buy land, young man, young woman, because there's not making any more of it. But the thing is that when you get in a 30-year fix, you're paying 50% of the interest in the first 10 years of that note. So what that means is that, the money that you pay for that is going right towards the bank mostly anyways. So, folks will look at these programs and put them up side by side. And that's a very, that is a very fun thing for me to do, is to show people how well this program can work. And one of those ways to do that is to, and I've had several clients, and some of them do pick a 30-year fix just because they're terrified of the reverse mortgage. It's a new scary program. They don't want to go forward with it, which is fine. I'm not a pushy salesman. I present the full spectrum to people and let you pick and choose with your family what you think is going to be best. But there's been several occasions where I've had someone who was looking to downsize, and sometimes they want to pay cash, sometimes they want a 30-year fixed. So a lot of times what I'll do is I will put together a comparison chart for them showing, okay, well, if you did a reverse mortgage, this is what it would look like. If you did a 30-year fix, this is what it will look like. And more often times than not, they're going to choose the reverse mortgage. Why? Because they're not coming out of pocket and getting access to that equity and having more of their monthly income that they're making instead of paying interest on a mortgage. Well, guess what they're doing with that money? They're putting it in their pocket. So having that peace of mind, knowing that you never have to make a mortgage payment out of pocket for the rest of your life, as long as you live in the property, coupled with the fact that you have that peace of mind, it's just a beautiful program for people. So some of the benefits of a reverse mortgage is you get to keep the title to your home, despite what your uncle's telling you down the street. The basic credit and income qualifications. Again, they just got to make sure you qualify for, taxes, insurance, things like that, monthly living expenses. Tax-free cash from equity. That's a huge deal. When you take money out of a reverse mortgage, let's say you want to take 50 grand out and put a down payment on Maserati or something. You want to take some cash out. Well, you take cash out, it's not considered taxable. So one, it's not going to affect like Medicaid qualifications or things like that. It's not taxable because it is considered a loan. You got to pay it back. You take money out of a reverse mortgage, or you replace your current mortgage with a reverse mortgage, you got to pay it back. Well, this is the only program that's due the day after you pass away. But or the day after you move out of your house permanently, I should say. So that's not a bad deal for those folks out there. And, there's a big sentiment with a lot of my clients. And can you really blame them? They want their last check to bounce. I think I would want my last check to bounce, So, thinking along those lines, you can put yourself in a position where you have access to more of your equity and where you have more control and more peace of mind over your assets as you age. Two biggest myths. We got our guy with the tinfoil hat on here. I'd love to open up a business and just sell tinfoil hats. I think they would sell like hotcakes. So two biggest myths. You lose title to your home. You don't lose title to your home. That is one of the biggest myths about this program. I can't begin to tell you, and these are folks who are, CPAs, people, financial planners, real estate agents, people who really got robust businesses or doing well. I can't begin to tell you how many of them, call me about a reverse mortgage or want more information and say, I'd really love to do one of those, but I don't want to give up the title to my house. Or I don't want my mother to give up the title to the house to the bank. You just hand it over to the bank, right? No. That's not at all how it works. It's just a lien. It's a lien, just like any other lien. Just like if you go out and you buy a house and you get a 30-year fixed mortgage, you have a lien against the house. Now, when you go to the county records and you pull up all the records, yes, you are the person that it shows you are the owner of that property. You have all the rights, quiet enjoyment, all that stuff. But there's a lien against the property. So what that means is that that lien, if you don't satisfy the terms of that lien and that deed of trust, well, the bank can take the house back from you on a forward mortgage. Because if you don't pay those payments for 90 days, they can start the foreclosure process. And if you don't pay for another 3 months, or get their settle up with them, then they can sell the house from under you. So do you really own that house? I mean, yeah, technically you do, but you still have a lien against the property. Same thing with a reverse mortgage, except it's a much better situation for the consumer. Why? Well, let's think about this. I've had some experiences in the past where people would call me and they said we're afraid to call the reverse mortgage company because their client or their mother or someone had just passed. And they call me and say, hey, we're afraid to call them because we don't want them to take the house. And on a forward mortgage, that's a legitimate concern, because if you don't make those monthly mortgage payments like they dictate to you, and really we call them monthly mortgage payments, but we should be calling them monthly interest payments for those first 10 years. So if you don't make those monthly interest payments to the bank, they're going to call you and say, look, we want our money. And if you don't get it to us, we're going to start the foreclosure process. Of course, if someone passes or something like that, a lot of times they'll work with you, but that's not a guarantee. And if you pull up your deed of trust, that's not what it says. It says, if you don't make these payments, we're taking the house. So on a reverse mortgage, there's actually a very detailed process. In fact, I just got a call this week about this. It's not a loan that I did or that I'm involved in, but someone I'm kind of known here in the area as a reverse mortgage guy. And they had me someone called me that just needed some advice. Her father had passed away, and they were looking to find out, okay, well, what do we do? What do we do now? The reverse mortgage is going to give you 6 months to determine the heirs. It'll give the heirs 6 months to determine what to do with the property. And then they're going to give you another 3 months extension and an additional 3-month extension. But those extensions you have to ask for. So essentially, you're going to have 12 months to determine what to do with the property. Now, this particular situation, she called, he had a reverse mortgage. He owes about $156,000 on the mortgage. So her father passed away, 3-bedroom, beautiful home in the mountains, Parachute, Colorado here. I don't know if you're familiar with that. Beautiful area. Just past Glenwood Springs there, right before you get to Grand Junction. So basically, house is worth about $300,000. The reverse mortgage balance is $156,000. So she has got a decision to make. Do you want to keep the property? Because there's some significant equity in there. There's over $100,000 of equity. That's another point I want to make with this program is that, secondly, the other myth here on our slide is that the second you do one of these, you're upside down on your property is what people assume. Well, this fella's had this reverse mortgage for about 6 years, and he's still got about $150,000 in equity in there that he left to his family, to his heirs. So now the daughter is basically going to make a decision. Does she want to keep that property as a rental? Rentals are doing pretty darn good here in Colorado, especially up there in the mountains, because they have a housing crunch. So the rentals are doing pretty good. So if she wanted to make that a rental, basically what she would do is she would just refinance that balance into her name. So she wouldn't qualify for the reverse. So she'd have to get a regular plain Jane 30-year fixed, 15-year fixed loan. So basically she'd have to pay off that $156,000, or she could pay off cash, Most people don't have 156,000 sitting around, and quite frankly, I wouldn't recommend that. Yes, of course, the mortgage guy is telling you you need to borrow against the property. I don't have a biased opinion, do I? Well, of course I do, but it makes sense though. Stay liquid. Equity is great to have, but it's a lot like having a glass coffee table right there in the middle of your living room full of cash that you can't get to. So I digress. You got you got a situation where she can refinance that 156,000, turn it into a rental, turn it into a second home, or she can move into it. But that's all she's got to refinance. So even though the property's worth 300,000, or she can sell the property and cash out. There's still a significant amount of equity in that property, and this fella's had that reverse mortgage for 6 years. So, a lot of people think that when you do a reverse mortgage, oh, you're upside down the next day. That's kind of like the farmer going out and planting his crops and going out the next day and saying, "Hey, where's my yield? Where are my crops at? Where's my yield at?" It takes a really long time. It takes a long, long time by design. Why does it take so long to go upside down on a reverse mortgage? Again, like we talked about earlier in this presentation, I hate to break it to you folks, but the banks are here to make a profit on us. I know that's tough news. I know it's tough news. But the banks, yes, this is a loan and they are going to make a profit. Now, the difference between how the banks collect their profit on a normal situation, a normal 30-year fix, they're getting their profit every single month by using that amortized schedule where you're paying mostly interest and a little tiny, tiny bit of principal on your loan for those first, 5-10 years. So the longer you're in it, the better it gets. But for the first 5 years, boy, those terms are really stacked against the consumer. So that's how they're getting their interest. But in a reverse mortgage, they get it at the end. So the 156,000 that this gentleman owes on the property, he probably owed a lot less than that 6 years ago, or a little bit less than that 6 years ago. But because he made a decision not to make his monthly payment and use that payment for his quality of life, so he probably had a much better quality of life because his cash flow had increased, because the money he was normally using to make his monthly mortgage payment with, he was just putting in his pocket. So he's able to live. So she's got a decision if she wants to refinance the property, turn it into rental, move into it, secure it in her name, or she can sell it and cash out. So again, the reason it takes so long to go upside down on these is because that's the whole risk the bank is taking. If you go upside down on this property, the bank just lost. And someone's going to be on the hook for that. So the way they structure these is that they won't allow you to borrow a lot of money. That's why you got to have a lot of equity with these reverse mortgages. But it's going to take a really long time to go upside down as well, because that's how the bank has structured these loans so that they will be profitable. It's all about the profits to them. I know that I hate to break it to you folks, but the banks, they're here to make money off of us. You lend them $10, you give them $10 in your deposit, they're going to lend out 9 of it. So it's really, that's literally how the banks work. This program is no different in the sense that it's governed by several banks. So as a broker, we have relationships with several. We have a great relationship with the Mutual of Omaha. We also, AAG, you've probably heard of them as well. That's our buddy Tom Selleck's out there, working for them. We're also signed up with them, Longbridge, SmartFi. There's a bunch of different banks that we use. And, this is our specialty. This is what we do. We're very good at it. We know the ins and outs of this program. And I would encourage you to watch some of our past videos as well. We've been doing this a long time, and I've been teaching this class for the state for about 8 years. So knowing the good, the bad, and the ugly is, I think, very important for folks. And I think that they need to be informed so that you can make a good decision for your family, because it affects your future. So it's hard to talk about these programs without talking about retirement in the United States. Now, there's all kinds of stats I can show you. If you really want to have a downer day, sit down with a financial planner and have them tell you how bad things look for the country in retirement. Because I can put a bunch of stats together, but the long and short of it is that not enough people are saving for retirement, and the folks that are saving aren't saving enough. So it's one of those things where you find a sense of purpose to help people that are in a situation really in a crunch right now in retirement. Yeah, those were just stats showing how bad things are. So cash flow. Cash flow is really the biggest thing that people are concerned about, strive for retirement. It's all about cash flow. And really, mainly what I try to instill in people are passive forms of cash: annuities, pensions, retirement withdrawals, investment properties, things that can help you generate income when you're no longer able to generate the income on your own. So that's one of those things that it becomes a huge crunch in retirement. So it's the number one issue in retirement is cash flow. Cash flow issues in retirement arise due to fixed incomes, inflation, unexpected expenses, potentially outpacing available savings and investments. So these are the three buckets of finance. Okay, and these are pre-retirement. So this is before you retire. You have income. You're saving income, so you're putting some funds into this bucket. And then you're also paying off your home equity as well. So the equity is going down over time. So these are the three buckets of finance. And this is what it looks like pre-retirement. Usually we're putting money into savings and paying off our home. We're working. Well, post-retirement, these buckets change quite a bit. The main thing you're going to notice is that this bucket, the income bucket, gets smaller. When we're retired, we're on a fixed income. We're not working as much. Who wants to work into their 70s and 80s? I mean, some people are content doing that, but not everybody wants to do that. And most people can't. At some point, our bodies tell us it's time to stop. The second bucket becomes extremely important and gets put on a pedestal here, gets put on its throne, because our nest egg becomes vitally important, mainly because we don't know how long we're going to need it. We don't know if we're going to live to 70. We don't know if we're going to live to 80, to 90, to 100. We just don't know. But the difference between 70 and 100 is 30 years. So you may have to plan financially to survive for 30 years plus with your nest egg. It becomes vitally important in retirement. And the last one is your home equity. A lot of times people have paid their house off, or they have a significant amount of equity. The equity is not doing you any good in retirement, mainly because it's not liquid. It's great to have equity, but it's a lot like having that glass coffee table right there in the middle of your living room full of cash that you can't get to. So what the reverse mortgage does is it opens a little drawer in that coffee table, that glass coffee table, so you can take cash out if you need it. Well, that's going to do it for today. Thank you so much for your time. Once again, my name is Zach Smith. If you have questions about a reverse mortgage or would like to schedule a consultation, you can reach out to me at chariotreverse.com. That's chariotreverse.com, chariotreverse.com. Thank you so much. I hope you have a great day. Many blessings to you and your family. Thanks a lot.